All right. Thank you so much for joining us today. I'm Matt Hilland, a financial planner here at Arnold & Moat Wealth Management. And our topic today is the dangers of dividend investing. And obviously, we're not saying that dividends are bad or all dividend-paying stocks are bad. But what we're referring to here is a concept that's getting really popular being regularly pitched online about heavily concentrating your investments only in dividend paying stocks or high dividend paying funds and using those investments with the intent to create some kind of income stream from those dividends. And the strategy usually is centered around this idea of never touching your principal and being able to live solely off of those dividends in your retirement plan. I just included a few examples that were easy to find here, covers of magazines that talk about this strategy. Sites like YouTube are full of this type of content, hundreds of videos with millions of views, all talking about how they are going to, create this plan to be able to retire off their dividends. And tons of people are searching for content like this. There's lots of content that takes advantage of some people just trying to educate themselves about the basic ideas of investing in general. And besides media and bloggers, fund companies are behind this craze too, because anytime you can add any little bit of complexity or nuance to an investment strategy, they can charge more, so they like that. And shown here is two funds from one of the larger ETF providers out there, Spider. On the left is a fund with the ticker symbol SPTM. This is your very basic, boring, low-cost index fund. It just simply owns 1,500 individual stocks, essentially a huge chunk of the total stock market. It charges a fee of just 3 basis points or 0.03%. In our eyes, this is just a really great fund that could really be the keystone of a really great retirement portfolio. And then on the right here, we're showing a different fund by the same company. This one has the ticker symbol SDY and is a fund that starts with those same 1,500 stocks as SPTM, but then it removes all the companies in that list that haven't paid a dividend for a certain number of years. And in fact, it filters out about 90% of the holdings, only invests in about 130 companies. And for that extra work of screening these companies, they charged a fee about 11 times higher, a little bit more than 1/3%. And also shown here is the assets in each of these funds. And so in SDY, for example, you see it has about $21.3 billion in assets, more than double what's in the other fund here. And so fund companies love this too, because here's a fund that charges 32 basis points more, or just about 1/3% in premium to invest people in certain dividend paying stocks out of this index. And then here I added that extra 0.32% on that $21 billion ultimately gives Spider about $70 million in added fees just by being able to attract people to the idea of a dividend ETF rather than a kind of boring index fund here. And yet, investors continue to throw their money at these types of dividend funds. This fund is not alone in its success. And so, to be fair, besides kind of those marketing and media type of influences that reach a lot of investors, I think there are a couple reasons that dividend investing at one point in history had some merit. One is that before the internet in particular, the fees to trade and just invest in general were much higher than they are today. This chart on the left is showing just the historic average trade fees by ways of commissions on stocks over time. And you can see that until the mid 70s, it could be pretty common to pay 0.8 or 0.9% just to do a trade. And then the chart on the right here is showing average expense ratios of funds. So if you didn't want to buy individual stocks, you had to use a mutual fund or an ETF more recently. This chart showing the average expense ratio or basically annual percentage fee that you would have paid over time. And so even just 20 years ago, very common to pay a percent or more uh, for to be able to invest in an ETF or a mutual fund. And so if you were in the position where you needed income from your retirement, and one option was to invest in dividend-paying stocks, and the other was to pay 1% commission to trade, another 1% per year just for holding a fund. I could see some validity to a portfolio of just dividend-paying stocks that automatically sent you a check every month or quarter. But this is just not the case today. It's pretty unusual to pay a percent commission for trades anymore, unless you're working with a broker. Fund fees can be well under 0.1% now. We just looked at that last index fund that charged 0.03%. And so, I think this is one thing that kind of made dividend investing popular decades ago that people are still kind of clinging on to a little bit. And then the other is that the components of returns have just changed a little bit. Back, in the 40s, 50s, 60s, and 70s, many more companies paid dividends on their stocks. They paid out a larger portion of their profits as dividends. And this chart is just showing the return of the S&P 500 by a decade, and then the component of that total return that came from dividends. And so just for example, in the 1940s, the S&P 500 averaged just about 10% per year in total return, and about two-thirds of that return was solely from dividends. And then you can see as the decades go on here, the 40s was very high, 70s very high. But in general, these last couple decades have seen much lower portion of the total return of the stock market come from dividends. And that's just because companies are changing to be more focused on doing buybacks instead of paying dividends, or just retaining that money, reinvesting it in the company and trying to grow. Companies like Amazon, Berkshire Hathaway, those types of companies that have never paid dividends have been very successful, kind of influence this next generation of companies. And we're just seeing companies not pay out that much in dividends anymore. And so again, if you grew up investing in the 70s, dividends were a huge part of your return. They are not so much anymore. And so, besides kind of some of these issues we just briefly touched on, what is the problem with focusing your portfolio on dividends? Kind of optimizing your asset allocation on only investments that have a certain dividend yield or that pay dividends. We're going to go through these 3 points in particular going forward here. And the first one is just how difficult it is to have a diversified portfolio if you're focusing on dividends. As I made the point in the last slide, the number of companies that are paying dividends now is much lower than it has been in the past. Today, only about 40% of companies actually pay any kind of dividend at all. And you can see back in the 40s and 50s, it was upwards of 90% of companies paid some dividend on their stock. And so again, just over the last few decades, we've seen this pretty dramatic shift in companies not paying dividends and instead just hoping that that money reinvested in the company can lead to kind of bigger returns going forward. And so what this looks like for someone creating a retirement portfolio around dividends is much more concentrated investments in different parts of the economy. And so this is a side-by-side chart of what's sometimes called like a style box that shows how the investments in a certain fund are kind of split up between large companies or small companies, growth companies, or what's called value companies. And so on the left here is that SPTM. This was that very basic low cost index fund. On the right is that same dividend fund, that SDY. And then these boxes kind of show you the percent of assets in the fund that are invested in a certain area. So, for example, SPTM has about 17% of its assets in large growth companies. You'll see a big difference here as you just start to look in that this dividend fund has almost no growth type companies. So these are companies, a lot of tech companies that are starting out growing and they can't afford to pay off dividends. These are companies, I'm trying to think like Facebook, like Amazon, like Apple for quite a while that just don't pay dividends because it's worth it for them to reinvest their earnings back into the company. And so you can see there's some pretty big differences here in how the investments in these two funds are allocated. This next slide's just a different way to try to show the same thing. So there's two columns here of the different sectors that these funds are invested in. Again, SPTM, that basic index fund, SDY, that dividend-focused fund. And you'll see some very big differences here in how these funds invest. And so it would be a very honest mistake to think you're buying this dividend fund focused on the S&P 1500 stock index and not realizing that you're very differently invested than the general market. You're much higher allocated to things like utilities, defensive companies, and have much less in technology than you would think. And that leads to some difference in performance from the general stock market. So this is a chart here showing the performance over the last 20 years of $100,000 invested in either one of these funds. The purple line is SPTM, again, that very basic index fund. The orange line is that dividend-focused fund. And again, what we've seen here is that concentration in things like utilities and consumer staples and away from technology eventually starts to hurt you when we get into a period where technology starts to perform very well. There's also, I think a little bit of a drag here, just that higher fee over a 20-year period is going to start hurting the ability for that dividend fund to compound as much. And just an important note here, this chart is showing the total return. So this is assuming that dividends are reinvested. So we're not neglecting the fact that this dividend-focused fund pays a little bit higher of a dividend. We're assuming that both of these funds have their dividends reinvested. This investor is kind of trying to get that compounded growth here. And this is just kind of the first piece of evidence that we're going to look at that high dividend does not necessarily mean high return. And, here I would much rather be an investor with, $666,000 with a little bit lower dividend yield rather than only having 521,000, but maybe 1% higher in dividend. And this is not something, not meant just to pick on that specific fund. We see the same trend across any other fund family that offers both dividend-focused funds and just general stock market funds. So this chart in the top left is the same view of Vanguard. The fund in purple here is Vanguard's total stock market ETF, another just very basic index fund. The orange line is Vanguard's big dividend fund. And again, you see a little bit of a difference in performance, a little bit of a lagging of a performance. Schwab has the same kind of lineup here. SCHB is Schwab's very broad index fund, owns thousands of companies. SCHD is that same index, but they filter out just certain number of dividend-paying stocks. And again, very similar shape in the charts here, some long-term underperformance from those dividend-focused funds. And so another way besides looking at just a few specific funds, there's been some bigger studies that take into account the many hundreds of funds that are out there, and they all kind of point to the same evidence that high dividends do not lead to higher total returns for investors. This chart on the left is a study from DFA, or Dimensional Fund Advisors, that is plotting the dividend yield of a fund, and then the y-axis here is the 10-year return. And so if there was a correlation between high dividends and high returns, you would expect a chart that kind of goes up and to the right. And instead, what we see is a little bit more random, and certainly not evidence that as you go to the right here, as you get to higher dividends, you end up with higher long-term returns. This just is not the case, and maybe some evidence here of actually even lower dividend funds having higher 10-year returns. The chart on the right here is a much longer term study. So this is looking back all the way to 1928 in periods of high inflation and looking at the return that investors received in companies that were either very high dividend paying stocks, not payers at all. They paid a dividend but were very low. And here you can see that in these periods of high inflation, high dividend paying stocks had actually underperformed by a pretty good amount compared to non-paying companies. And again, I just think this is interesting and was top of my mind since more recently here with our last bout of inflation, these dividend-focused stocks became really popular again, with people thinking that the dividends would do a better job of keeping up with inflation. And there just is not evidence that that is the case. And then the last bullet point here that we have is what we see as an issue with the general dividend-focused strategy is there's this idea that building a portfolio that lives off of dividends is much safer than than a portfolio where you have to actually sell some shares. And in particular, this idea of creating this portfolio where you never have to touch the principal. You just sent a check every month and you never have to go in and sell your shares. There's a couple big faults with this line of thinking. One is that dividends are just a return of capital. It's not this income that comes out of thin air, magically appears in your account. When a company pays out a dividend, the value of that company drops because now all this cash has left this company and it's not worth as much. And so this visual on the left here is another study from DFA, and they analyzed how the share price of stocks performed right after they paid out a dividend. And so it looked at the 10 largest dividend-paying companies in the S&P 500 over a 5-year period here. And the average dividend that those companies paid was $1 per share. The next day, the average decline in the share price of those companies was $1.15. So again, you got $1, but you lost $1.15 in value. And so right there you can see you are actually getting some of your principal back in a sense when you receive a dividend. You're not going in and selling $1 worth of stock, but the value of your investment's going down $1. And this chart on the right is just another way to show kind of the accounting of, being paid via dividends or being paid via just selling your shares. So on the left, if you have 100 shares of a company whose stock is $20 a share and it pays out $1 dividend, $1 per share in dividend, that is, now you have 100 shares that are worth 19, and you have $100 in cash in your brokerage account or your bank account. And so on the right, we just say, hey, you have 100 shares of a stock that's at $20 per share. You sell 5 shares to get that same $100. Now you only have 95 shares at $20 per share. It's the same thing. You're ending up with $2,000. This feels a little different because you're selling 5 shares, but ultimately it ends up being the exact same thing. And then the other thing, just going along with that, is that there's this idea that dividends are this very safe and secure source of income. If you can build this portfolio that just you can survive off of the income from dividends. It's this very safe and secure retirement, and it's this little bit, quite honestly, I think a contradictory view because you don't have trust in the stock market that it's going to perform, but you do have trust that these stocks are going to continue to pay out their dividends. And what we've seen historically is that companies cut their dividends in bad times. And so this first chart here is just a look at how the income received from $1 million portfolio would have changed as the COVID crisis hit. And so, for example, if you had $1 million invested in general US stock market, right before COVID, you were getting about $15,000, $16,000 a year in dividends. That next year, you were getting, less for international stocks. It was an even bigger drop. For emerging markets, still a drop again. And so again, this is just one point in history here. But if you were building this portfolio to kick off a certain amount of dividends that you needed to live on, and you had this drastic cut in your income, that's not a good plan, right? Now you're having to sell shares when the market's way down to kind of recreate that income. And, we've seen this many other times before too. This is just another way of looking at the COVID crisis and putting a number behind the number of companies that actually cut their dividends as COVID kind of unfolded. It was as much as, about 35, 40% of all companies that paid dividends cut or eliminated their dividends in the second quarter of 2020. This was a huge impact for dividend investors, people that were heavily concentrated in these types of companies. And it's something that we've seen more than just the COVID crisis. In a few years prior, the 2008, 2009 financial crisis was notorious for seeing some of these companies with many decades of histories of paying dividends, halting or just significantly cutting their dividends. So General Motors had paid a dividend since 1922, and in 2008, that went to zero. Of course, the company went bankrupt too eventually. General Electric, or GE, had paid dividends since before the Great Depression. And 2009, it finally cut that dividend for the first time in 90 plus years. And of course, GE, GM were not the only ones. There was, as the Wall Street Journal said, a parade of companies that cut their dividends at this time. A lot of banks that had paid dividends for many years also did. And this left investors who were depending on this dividend income for their, pay their bills in retirement. They were in a very, very tough spot at this point. And so, again, just dividends are not guaranteed at all. And so, the other idea here is that, not spending your principal is somehow a very good retirement plan. Being able to just live off of the dividends is something that you should strive for. And, from our point of view, that's really not a good goal to have. You end up really limiting your spending if all you do is live off of your dividends from some of these funds. This chart on the right is looking at the dividend yield of some of those funds that we looked at in the prior slides. And so just for example, that Schwab dividend ETF is in blue here. It has a yield of about 3.3%. And so then we look at, hey, if you put all your money into the Schwab dividend fund, you can live off of 3.3%. What does your retirement end up looking like? And it turns out that under almost all historic, kind of scenarios, you drastically underspend. And so here I rounded up that 3.3 just to 3.5% and assumed, just a basic kind of 65-year-old retired couple with a 30-year horizon with $1 million. What does their portfolio look like when all they take out is that three, in this case, 3.5%, whether it's from dividend yields or not? And on the right here, we're showing what's called a Monte Carlo analysis of that $1 million portfolio. And what it's showing here is, we don't know how the stock market's going to perform in the future. So what Monte Carlo does is run, in this case, 1,000 different uh, scenarios of kind of randomized stock market returns. And so if you are in some of these different percentiles, it's kind of like a likelihood that your portfolio would perform, within these ranges over time. And, so what we would highlight here is that, on average, a 65-year-old retired couple with $1 million and kind of the somewhat aggressive portfolio to try to mimic a holding in 100% dividend fund, on average would end up at the end of their lives with somewhere around $10 million. And, it's a lot of people have a goal to leave money to their heirs, and that can be great. A lot of people don't have a goal to drastically underspend during their retirement and leave their heirs with seven figures of their savings. And even in some of these very low percentile, or in other words, very unlikely scenarios, you're still left with very sizable sum. And everyone always has this worry about these kind of worst case scenarios. There is, of course, scenarios where the Great Depression occurs and a certain withdrawal rate is not sustainable. I would just remind you that's equally as likely as having above average returns and having a portfolio that would end up, well north of 10, $15 million at the end of your life. And so I think this is just worth thinking about that, if you have this goal of having a sustainable retirement plan, don't set that up to be just being able to live off of dividends, because historically it means you drastically underspend. You can spend much more than 3.5% of your portfolio in normal kind of stock market years. And of course, working with a financial planner or just having the flexibility to sell some shares when you need more money gives you a lot more flexibility to kind of have a retirement that I think a lot of us would prefer, rather than kind of being on a fixed income and underspending for so much of your retirement. And then finally, there's a few other just kind of random considerations that are worth noting around dividend investing, particularly if you have a lot of money outside of retirement accounts. So if you have a lot of money in a brokerage, there's a lot of tax advantages to not focusing on dividends. So doing what's called total return investing just means effectively selling shares when you need money and not investing in an investment solely because of its yield. And so, what we see is that dividends just offer you no flexibility. If you want to sell shares when you need money, you have a lot of flexibility on when to sell those shares, when to recognize capital gains. When you're living off dividends, you don't have a choice there. You're going to receive that dividend every month or every quarter, whether you need it or not. And then also dividends are 100% taxable. And by that, I mean all the income received from dividends are taxed either at your income tax rate or long-term capital gains rates. And when you sell shares, you're getting a portion of your original investment back. And so, if you sell $100,000 worth of stock or worth of fund, it's very likely not $100,000 of gains, right? You put in some original amount of money into that you get back. And so just to be able to get, $50,000 out of a portfolio is cheaper when you're actually selling shares rather than getting $50,000 from dividends. And then, the final 2 points here is kind of just summarizing what we talked about before. It's much easier to get a better, more diversified portfolio when you're not worried about yield, worried about dividends. And in general, companies are just moving away from paying dividends. They like retaining that profit. They like buying back shares rather than paying dividends because, again, that gives investors flexibility on when to actually recognize that income. And then from a portfolio management standpoint, just the act of rebalancing some of these annual maintenance items that are needed in a retirement account is much easier when you're just kind of utilizing a total return approach. When you have all your money invested in one or two, kind of dividend funds, it's tough to, rebalance, get those investments allocated as you need. When you can sell shares, you can simply just kind of sell your outperforming funds. So right now, that might mean selling large cap growth funds to get everything back in line. And it's much easier to create this better long-term sustainable portfolio. And so thank you again. I know getting into some details of this topic here, hopefully this was interesting and helpful on just why we invest our clients the way that we do, why we tend to caution people from, really heavily focusing on these dividend focused funds and stocks. Of course, we're on here. If you have any other questions, please enter in the chat or send us an email and we'll get right back to you. If there's nothing else, happy Friday and have a great weekend. Thank you.